the don't fight the Fed mentality, that if the Fed is raising rates, then stocks go down, and that's all. And that's what we see in the market, certainly in the first 6 weeks of the year, that just things were too negative. That investors are really focused on is the Fed, going to over tighten policy? Are they going to go too far and cause a recession?
Welcome to the Millennial Investing Podcast. I'm your host, Rebecca Hotsko, and on today's episode, I am joined by Sam Burns. Welcome to the show, Sam.
Hi, thanks for having me.
Thank you so much for coming on. I've been really looking forward to this conversation to get your outlook on what's happening, because coming into 2023, it seemed like the biggest risks that were facing the market were surrounding earnings downgrades that were not yet embedded in prices, inflation being sticky, and the Fed's ability to get us back to this 2% target on time. And so what's been really interesting to me is that the main narrative just a few months ago seemed to be that the first half of the year was going to be bad, and then the later half would likely be a rally or get better. But we haven't seen this play out this way so far at all. And so, in fact, the market has done quite well for the first part of the year. So I wanted to get your thoughts on what's happening and your current outlook for the market, as it seems like things just haven't turned out as bad as some initially expected.
Yeah, no, you're absolutely right that a lot of what you saw looking at the news and what I was hearing even from clients late last year was pretty negative. They thought it was a bad year last year and was going to basically keep going and be a bad first half of this year. The economy was slowing rapidly due to the Fed, and that earnings were going to fall off a cliff, and that the market would fall to much lower lows, and that was kind of the picture, the setup going into from October, November, and December. And I think, what's happened is that partly the economic data has been so volatile that it's hard to get a clear read on what's going on nowadays. And a lot of people were kind of looking at some of this, slightly slower data last year and extrapolating that, kind of overly in a negative way into the first half of this year. And also probably extrapolating from, seeing the Fed hike rates so aggressively. Well, that must kind of be, crash the economy any day now. And so I think what's happened is that the economy has actually been holding up better than people expected. It's not fantastic, but it's holding up fairly well. And I think that's, a difference from past cycles to some degree, but also just the fact that the data, in January was much stronger than the data in, November, December. And some of that is just, like I say, the volatility of the data, seasonal things, COVID's impact, a lot of things going on that confuse people and make the data harder to read. And I think a lot of people assume that, the don't fight the Fed mentality, that if the Fed is raising rates, then stocks go down, and that's all. And that has not really historically been true at this phase, and it's not true now, I think, in part because, fiscal policy is kind of acting as a countervailing force. And a lot of what's been going on the last 2 or 3 years has been very unusual and not a typical economic cycle. And so it's hard to apply the usual rules of an economic cycle to this scenario that we've been saying the last year or two. And so I think that's part of what we're seeing now. And so when everyone gets very, very negative about anything, more likely than not, any piece of good news will turn things and you get, kind of an uplift. And that's what we see in the market, certainly in the first, 6 weeks of the year, that just things were too negative. And, if things are less bad than expected, that's all you need to get a rally. And that's what we've gotten.
Okay, yeah, let's break this down a little bit more. The economic data and then the financial data. We'll get into the earnings estimates and the revisions a little bit later in the discussion. But on economic data, so you mentioned it's been volatile, and the most recent data that came out today as we're recording it on March 10th is the jobs report. And so can you talk a little bit what we're seeing there and why this good news is actually bad news?
Right. And we definitely have been in that situation in the last few months where any signs of better than expected economic news is interpreted negatively by the markets, because that means the Fed has to keep raising rates even more aggressively and for longer than would otherwise have been the case. And that's the risk that investors are really focused on is the Fed, going to over tighten policy? Are they going to go too far and cause a recession rather than simply responding to, inflation? And so that's kind of the situation we've been in. But I think today's economic data from the jobs report was maybe one of those kind of confusing ones where the headline data, 311,000 jobs created was above the consensus expectations from economists. So it looks like another, better than expected, stronger than expected report, and therefore a reason for the Fed to keep raising rates. But then if you look at the other pieces of the data, the unemployment rate actually rose to 3.6% from 3.4, and the average hourly wages that they track were slower than before, only up 0.2%, and the average number of hours worked in a week ticked down, and the labor force participation rate rose slightly to its highest level, I think, in 3 years. So all those measures that are below the headline actually suggest that the labor market is maybe a little less tight and the wages aren't growing as fast, and that maybe things are not as worrisome from an inflation standpoint as you might have thought. So if you're looking for bad news, you could find it. If you're looking for good news, you could find it in there too. And so the debate is now, well, how will the Fed interpret this, and will they use it as a reason to raise rates, say 50 basis points in a couple of weeks when they meet again, or stick to a 25 basis point hike? My view is probably that the 25 basis point hike, kind of that case got a little bit better today. And so I think that's probably what they'll do. But that's really the way the market's been trading, is just betting on how the Fed will look at the data as opposed to the data itself. This data by itself would be pretty good. Job market's pretty strong. Most people still have jobs, still growing, just not as fast as before. And that's really what you want. You don't want things to be overheating, but you don't want them to stop, or go into recession. And so, if you're just looking at it from an economic standpoint, it's pretty good, not bad. And that's why I think stocks have kind of been able to hold up, whereas the bond market has been much more concerned because they're more directly tied to what the Fed is going to do. And so that's kind of what they've been responding to. Now, today, of course, the market reactions have been kind of skewed by what's been going on in the banking sector and some of the tech-related banks that are blowing up and things. But overall, it's been driven by Fed perceptions, and that's the lens that they're looking at the economic data from.
Hmm. And I guess I just want to ask you then, the way things are heading right now, do you think that this suggests we could see higher highs by the end of the year? And I guess, have we already seen a market bottom then, in your view?
Yeah, my guess is that the bottom last year in October in the major indexes in the U.S. Will probably hold. We probably won't go below those levels, would be my guess. The indicators that I use to kind of look at how bullish or bearish I want to be on stocks, which I kind of constantly update on a rolling basis, looking ahead, say 1 to 3 months at a time, are still positive. They look like they're the things got very negative last year, and they're still kind of in the process of turning up. Certainly in terms of investor sentiment and in terms of the price behavior, but also the outlook for the Fed. We're much closer to the end of the Fed's tightening cycle than the beginning. Whether it's two more hikes or three or whatever it turns out to be, it's much less now than it would have been a year ago. And so my indicator suggests that we should at least be able to hold steady, maybe in a trading range, or grind higher over the course of the next few months. And so I don't know if we'll hit a new high in the indexes, but should at least hold up. I think stocks will probably outperform bonds as they have been for a while, but will continue to do so over the next few months at least. So I'm still a little more glass half full than probably some of my colleagues out there who do this sort of thing, and think the stocks should still outperform bonds and can probably hold up okay and grind higher, unless there's another big shock of some kind. Whether we got through COVID and we got through Russia and China. If there's something else comes along, then I guess that would change things. But right now, it looks like earnings are going to be okay. The Fed is probably going to, hike rates a couple more times and then be done. And then inflation will be lower, 6 months from now or 9 months from now than it is now. And so that will be a supportive backdrop for equities.
Hmm. So, from the conversations that I had a few months ago with a range of people, it seemed like a lot of people were expecting the market to fall by 20 to 30% based on the fact that earnings needed to be revised down. Now, we have seen earnings revised down, but we haven't seen that drop in the market. And so, is that just a factor that it was less negative than expected?
Right, exactly. I mean, most of the impact of earnings and estimates and things like that is really how it relates to expectations. And is it better or worse? Not really, is it up or down in absolute terms? And so certainly, yeah, earnings in the fourth quarter and potentially even in the first quarter will be, lower than they were a year ago and, got revised down. But to some degree, that was expected. And the actual results turned out to be not as bad. And the guidance from companies about, the next few quarters was not as bad as a lot of people had been anticipating, late last year. So very much a, question of relative to expectations. If expectations are very low, it doesn't take much in the way of, good news or even sort of less bad news to boost things. And the reverse is true if expectations are very high. So we've seen a lot of estimate cuts. Analysts reduced their forecast pretty aggressively for months and months and months, all last year and even kind of early this year. And that kind of has now priced in to some degree some of that negativity. And yeah, there are people that are arguing for more, that they're still not, they haven't cut enough, and there's still more downside to it. And I suppose that's possible. We're getting closer to the point where analysts will probably cut enough, or at least the pace of their cuts has gone far enough. And so if they cut a little bit more, but it's at a less intense pace, again, that's the directionally they're moving in the right direction rather than the wrong direction. And that's what we've been seeing recently. My data is showing that they're not cutting as much as they were before, and therefore that sort of headwind to the market has been reduced.
Okay, I want to get into your data and research in a second. I just have one more question about the economy, which is on the yield curve, because this is one thing I can't wrap my head around what's going on with this. We've seen it increase even further, the 210. It's become even deeply inverted, even more deeply inverted. So, what's going on here and what's this telling us?
Yeah, that's definitely been getting a lot of attention. It's historically inverted between the 10-year and the 2-year. Back to the early 1980s, I think is the last time we saw something like this. And I think it's, partly a result of the wide gap between what the market expects from inflation going forward over the next year or two, say, and what the Fed is looking at in terms of trading inflation or current inflation and how they think they have to respond to it, both in terms of having rates in line with what they think inflation is now, and relative to the fact that maybe they were a little late raising rates, last year when inflation had already started to rise. So I think the assumption that the Fed is having to sort of catch up to where they should be, and that means the short end, the short-term interest rates, the 2-year has to be high, but that's going to slow the economy. The inflation will probably be coming down naturally and come down maybe faster now that the Fed is so tight, and therefore that rates will, say in a year or two, be lower than they are now. And so that it doesn't make sense to price long-term bonds, up at 5% or more if you're pretty sure that short-term rates will not be that high in a year or two. And so it's a relatively unusual scenario right now, that the market is looking ahead and pricing in what they think the Fed will do, and the Fed is still kind of talking like it's going to stay, where it is for quite a while. Now, the bond market has been wrong before, and the Fed has been wrong before. You have to assume that these all things will all change as things develop. But I think that's kind of what's driving things right now. And the fact that we have high inflation really for the first time in 40 years is kind of confused people to some degree, and has made people question what the Fed's real policy parameters are. They've been trying to get inflation to go up for a long time, and now they've got it, and it's got too much. Are they going to change their inflation target? Are they going to keep it where it is? How aggressive are they going to respond? And how does it interact with fiscal policy and, what's going on globally and all the other things that affect inflation in the economy and cause the Fed to have to respond? So I think the question is, what is the Fed's real kind of reaction function right now? And the market has a different view of what the Fed has officially been saying when they, speak publicly.
Okay, so then in a sense, is this widening gap maybe not as bad? It's saying that the market expects inflation and economic growth to come down then. So it's basically saying they have faith in the Fed's ability to get us there.
Yeah, no, the market definitely expects the inflation rate to come down and the economy to slow, and that what the Fed is doing to have an effect. If you really thought that the Fed was not going to be effective in bringing down rates, and you thought inflation would stay high, you certainly wouldn't be interested in buying a 10-year bond at 4% or less. So if you really believed that there was going to be a big, kind of 70s style inflation, spiral, you would not be seeing, long-term rates do what they're doing. So I think people are looking at it as the Fed will eventually be effective. It may take a little longer than they would hope, but that will work. And if the longer term structural drivers of inflation and the economy in terms of population and productivity growth and things like that are still tilted toward lower inflation, lower growth. They're not like the 70s and 60s and even the early 80s when conditions were very different from that standpoint. And so that the kind of the pre-COVID conditions that got used to will eventually come back, assuming no major world crises. And then it's just a question of how long it takes to get there and what policy levers have to be pulled to get there, but that they will get there in the next, say, 12 months or maybe 18. And that's why the yield curve is priced that way. But it also reflects the volatility of the economic data, that it's just hard to get a clear read. And therefore, there's more distortions in the bond market than usual, more volatility than you.
Hmm. And there's been research that shows stocks don't typically bottom until the yield curve turns positive again. And it doesn't bottom until later in the Fed tightening cycle. And so, what's happening? Could that be different this time? Could we, like you mentioned, see stocks bottom without that positive inversion? Or what's going on there?
Yeah, I definitely think it's possible. I think, yeah, I mean, you're right that there's a tendency for the yield curve to lead in that way. But it's also, there's a lot of variation in the historical, tendencies that way. And I think in this case, the fact that, nominal growth is still fairly high and the fact that fiscal policy is still relatively supportive, compared to, historical tendencies, that you've got the Fed tightening in some sense and fiscal policy still, being somewhat supportive, that they're kind of offsetting each other, rather than both being pointed in kind of the tightening or the negative direction, which has been the case a lot of times in the past that you've seen, is that you see monetary policy tightening and particularly over tightening, which is what an inverted yield curve tells you. The market thinks the Fed is overdoing it, and fiscal policy at the same time, cutting the deficit, cutting spending, all those things happening alongside tighter policy. And that's not happening now. Now it could, but right now it's looking like the fiscal support that we saw from COVID is kind of still lingering around. And the other things, infrastructure bills and some other spending things that are going on at the federal level are still, being supportive and keeping one of the metrics you can look at is the federal treasury deficit, deficit to GDP ratio, just kind of how much is the government spending relative to GDP. And that's still on the higher side. It's way, way below where it was during COVID, of course, but it's still on the higher side relative to history outside of crises. And so I think that's helping to balance out kind of what the Fed is doing and will help mean that the inverted yield curve won't have the same negative economic implications, at least not right away, as the history might suggest. And that if earnings hold up, if the banking system holds up, because the other problem with an inverted yield curve is that it causes problem for banks. If they're lending at lower rates and they have to pay on deposits, then that's negative for them. They start to lose money. But for the most part, they can still lend money profitably and they have good balance sheets. Again, certain exceptions for those lending to the, technology or crypto side of things. But the major banks are still in good shape. They're not a problem. And so the yield curve is not going to bring the banking system, down, and is also, like I say, probably being offset to some degree by fiscal policy. And so I think all those things together mean the yield curve doesn't mean what it meant, in the past.
Okay, I wanted to get your outlook on financials later because I've had mixed views from guests on that. One thing I want to touch on with you before we jump into the stock side of things is inflation, because I've also had a range of views on what the inflation picture might look ahead. So you talked about what the market's expecting. What are you expecting? Do you think that we're going to get back to this target nice and easy, or do you think we could potentially see waves of inflation?
Yeah, it's definitely going to be, a little bit of a bumpy road as it's been for a while. Certainly, at least judging by the published data. My guess is that inflation will work its way lower. Certainly by the end of this year, it will be substantially lower than it is now. And now some of that is sort of mechanical in the sense that the way housing prices are incorporated into the CPI and things like that. There are known lags in the way they calculate it and things like that. I think even the underlying inflation pressures will moderate, partly because income growth will slow, and the labor market will get a little bit more balanced. Companies are already starting to kind of cut costs and consider their how many employees they need and what they're paying them and that sort of thing, relative to say 21 and 22 where there was a lot of hiring going on, and so I think the overall picture for inflation is going to get back to closer to normal. And you can see that in commodity prices, which are the most sensitive and the most easy to measure, measure inflation. They haven't shown any signs. They peaked, last June, and have really been kind of trending flat to lower ever since, and are at the lowest they've been in a year or so. So energy prices, food prices, other commodity prices, they're up and down, but they're generally trending kind of flat to lower. And so I think the prices of goods, things you buy at the store, are kind of being flat to lower already. It's really services and labor things that are where the source of the inflation really is. And I think that's going to moderate over the next, say, 6 to 12 months. And that, that's certainly the Fed being tightened, the housing market slowing down. Those are all things that will have an impact on the data over the next, say, 6 to 12 months. So I don't see a big driver for why you would get a sustained wave in inflation unless there's a big supply shock again from wars or pandemics or something else that would be that really disrupt the ability of the economy to supply things like we've seen the last few years. Sincerely hoping that's not the case, but we've dealt with those, I think, to some degree already, and I think there's a better chance that those get better rather than worse.
Okay, that was super helpful to hear. I want to jump back to the conversation on earnings revisions because I know your specialty at Mill Street Research is looking at these analyst earnings revisions. And I guess given the concerns in the market about a possible economic slowdown, recession, what have we been seeing so far on this for the year for revisions to these estimates?
That's right. Yeah, as I kind of alluded to earlier, the estimate revisions, so the changes to the estimates we've been seeing for months now have been quite negative. There's been a lot more estimates being cut than raised across the whole spectrum of U.S. stocks and globally, and that's been one of the drivers of the negative returns we saw last year, and kind of drove a lot of the worries coming into this year. But what we've actually seen just in the last, say, month or two is that the pace of estimate cuts has really eased, and particularly for the large cap stocks in the U.S., where there was a lot of the worries, whether it's the big cap tech stocks or some of the other more cyclical names. Those have seen much less negative revisions. And actually, the technology sector in my work, if you just look at all the stocks in the whole tech sector across the board, not just the few mega caps, they're actually turning slightly positive, which is the first time that we started to really see anything kind of a green side of things rather than all red. And we've also seen better readings on some of the other more cyclical industries and industrials or consumer discretionary things that are more sensitive to the economy. So that tells me that a lot of the cuts that happened have already brought our estimates down far enough, and that there may be some sign that they're at least going to stabilize or maybe even move a little bit higher for a little while. And again, all you really need is to see the cuts stop or at least slow way down to at least let the market catch its breath and stabilize and do a little bit better. And that's kind of what we've seen, I think, this year. And so, I'm looking at it both from the standpoint of overall revisions, just kind of which direction they're going, and they're getting, less bad, less negative. And then which sectors are the ones that are, driving things? Is it, is it like utilities and consumer staples and the defensive side of the economy that you'd expect to do well in bad times? Or is it the cyclical side, that are more levered to global growth or to, economic activity? And that's more where we're seeing the strength. And then we even want to look globally. We say that the estimate activity in Europe is actually stronger than it is in the U.S., which has been unusual. It's generally been the U.S. has been much stronger than Europe for years. We're actually seeing, and Europe is more cyclical and less tied to technology. That's been a sign of strength, even though everyone was assuming that Europe would be in deep recession by now because of the war in Russia, in Ukraine, and everything else. That hasn't happened. And China started to recover from COVID and everything they've been going through. So a lot of things that people assumed would be much worse right now have been less bad, whether it's, US or Europe or China. And I think you're starting to see that in the earnings and revisions data as well.
Okay, yeah, that was something that I was quite surprised about was the Europe picture and how it is held up way better than expected. And I guess on these revisions, I wanted to ask you, do you tend to focus on the quarterly revisions more or the full year? What is your approach focus on more?
It's a great question, and there's a lot of people who do things differently. So my focus is very much on what I call the year ahead, next 12-month estimates. So I'm always wanting to look at sort of those slightly longer term and have a fixed, kind of time window that I'm looking at for what the analysts are doing. So I'm looking at their annual forecasts for this year, say 2023 and 2024, and then coming up with a kind of a rolling estimate of what the next 12 months looks like from the analyst standpoint in terms of earnings forecasts. I really don't focus much on the individual current quarter estimates because it can be very noisy and can be sort of gamed a little bit, meaning that the estimates are brought down to a level intentionally so that the companies can beat them for the current quarter because that's how analysts maintain their relationship with their corporate managements and all kinds of things like that. And so the current quarter numbers are not always necessarily a reliable metric of what's going on a slightly longer term basis or what they really think. Now that it will play a part in the year ahead number. The current quarter is obviously part of that, but if they're just kind of tweaking their current quarter numbers, but they're not moving their full year numbers, then that tells you that that you really need to focus on the 12-month numbers to get a clearer picture of what the real fundamental drivers are and what's happening. So I'm always looking at the year ahead numbers and looking at kind of the ups and downs of that, which tend to be more stable and more predictive of relative returns for stocks, I found.
Right, because I was reading all the reports on FactSet in preparation for this interview, and I saw that for Q1 of this year, the estimates they lowered estimates higher than normal, but that is a more volatile picture than you're saying. So that doesn't really drive your investment process or anything as much as the full year.
That's right. That's right. Yeah, I focus mostly on the full year numbers, and yeah, when I look at the facts that data like that as well, and what they're saying is true. The estimates have come down more than usual in Q1, but in some ways they say you then expect the numbers to beat that by a certain amount. They'll be down less than what the current consensus calls for, just because the way the analysts kind of play that game. And to some degree, that was priced in the negativity we saw, in November, December last year, and that it got investors and analysts saw that coming a little bit and could anticipate that and price it in. So it's really more about what are they doing to their second quarter, third quarter, fourth quarter numbers, or 2024 numbers, looking ahead. That's really going to drive. If I'm making an investment today, I'm not basing it on what Q1 numbers are going to be or what Q4 numbers were last quarter. I'm basing it on looking ahead a little further than that, and those trends are actually looking a bit better now in my work, and so I think that's more relevant for forward-looking stock return forecasting as opposed to kind of explaining what happened, over the last quarter and what analysts have done, like what are they likely to be doing in the near term and for the future.
Right. So let's dive a little bit into your strategy now. How do you use this approach of estimating what analysts will do in the future and previous estimates of earnings or visions to inform your investment process?
Sure. So for the most part, I look at earnings estimate revisions on a kind of a relative basis, meaning, whether it's across countries, regions, or across sectors and industries, or across stocks themselves. I'm basically looking to see where are the strongest earnings estimate revisions, where are analysts raising their numbers most convincingly, and where are they cutting their estimates most convincingly, and finding where those kind of groups are, where are the strong areas, where are the weak areas, and then focusing the attention on the strong areas and avoiding the weak areas. Because my research really corroborates the idea that on average over time, the stocks or the industries that have the strongest earnings estimate revisions and that are then corroborated with the price momentum or the valuations that would support that tend to outperform the areas that have the weakest revisions. And so I'm looking for situations where the earnings estimates are going up, and the price of the stock, the relative returns are favorable, meaning that the market is responding to those earnings estimates, and the valuations are favorable, meaning they haven't already priced in all the good news. And so those three components are what drive my stock selection process, but also then kind of rolled up into the industries or the sectors or even the countries and regions that can all be kind of aggregated. And so depending on whether I'm talking to a client who does more kind of big picture asset allocation or a client that does, stock selection, I can kind of focus on the areas that are relevant in that way, but applying the same process basically across the board to look for areas of relative strength and weakness. And I have other tools that I use for kind of asset allocation. Do I want to be in stocks or do I want to be in bonds or things like that, kind of where you are in the cycle and, kind of what risk appetite is, things like that. So there's kind of two big parts to the puzzle, but the earnings estimate revisions are really for relative selection within the equity universe.
Very cool. So you mentioned three things that you look for there, and I'm super curious on the third thing that you mentioned on how you look for companies that haven't priced in those expectations. How do you, what information are you using? How are you finding this out?
Right. So for valuation, what I'm really looking at is the PE ratio based on the forward 12-month estimates that I mentioned. So, what are analysts forecasting over the next 12 months, and what is the valuation being assigned based on that? But also look at that not just by itself, relative to what the stocks, in particular stocks, own historical range is. So some stocks always trade at higher multiples, and some stocks kind of tend to always trade at lower multiples because of the industry they're in or the way their accounting works or whatever the case may be. So accounting for what's typical or what's normal for a particular stock or an industry is important to kind of scale or adapt what you think a high or a low price earnings ratio might be. And so I think the key is to look for, again, on a relative basis, is this multiple very high or very low relative to other companies or relative to its own historical kind of norms. And so if you find a stock where the earnings revisions are rising and the price momentum is positive and the valuation is maybe on the lower end of its historical range, then that's a favorable setup. That means that investors haven't already kind of assumed that the estimates will rise and price it all in, and that you can buy it at a reasonable price. So it's really more about avoiding the kind of the risks that come with buying very expensive stocks, even if they look like the estimates are going up. Sometimes that's been priced in. People have already kind of paid for that, and so you want to find stocks where that's not the case. And so, so I look for that as kind of the check against that if there's strong revisions and strong price momentum, you want to make sure you're not overpaying it, buying something with an extremely high PE ratio. That it's safer to buy stock with lower valuations, and that's how that kind of fits into the overall puzzle. So I'm not trying to say I'm a valuation expert and then I know every company's ins and outs and their all the details, but on average you do better owning cheaper stocks than more expensive ones, and particularly when you've aligned it with their earnings estimates and their price momentum.
If you enjoy this podcast, you're going to love our free investing newsletter, We Study Markets. We realize that not everyone has the time to listen to a podcast every day or even every week. So we took this same type of content and put it into an easy to read free newsletter. In just 5 minutes a day, you can stay up to date with what's going on in the financial world and what's happening with your money. And it's completely free. Join over 30,000 other readers now by simply clicking the link in the pop-up on this video and then entering your email. It's that simple. Just click the link in the pop-up, enter your email, and start knowing what's happening with your money. And I guess in terms of the current P versus the forward, so you're looking for a current P that is lower than its historical range or relative to its competitors, and then the forward P, are you looking for it to be lower than the current P?
Oh, I see what you're saying. Yeah. Ideally, right, because that would imply that the
Okay.
earnings that are forecasted for the future would be higher than the earnings currently. So yeah, that's certainly typically an ideal scenario, and certainly anything that's a sort of a growth stock that would be expected is that the trailing P would be higher than the forward PE. Now, it isn't necessarily required that that be the case in my process to be a favorable stock. Even stocks that have negative earnings can still be favorable to some degree if their earnings estimates are rising, meaning if their earnings are becoming less negative or maybe in the process of turning positive. But on average, you'd prefer to see positive earnings and growing earnings as long as they're not priced too high. The PE is not excessive. Then that's the most favorable scenario is positive earnings that are rising, price momentum that's supportive, and a forward PE that's relatively low.
Is this kind of a reversion to the mean strategy in a sense?
Well, the valuation component very much is. And because the other components, the earnings estimate revisions and the price momentum are momentum or kind of trend following components, it's good to have a balance that you have, some components of the process that I follow is sort of trend following me. You want to go with the stocks that are doing well and that has strong fundamental momentum and strong earning or price momentum. But you also don't want to get stocks that are too expensive or that are likely to revert to the mean in a valuation standpoint. So that's what the valuation does for you is it lets you have some of that mean reversion or, stocks that are cheap and maybe likely to re-rate higher as a tailwind as well, in addition to improving fundamentals. So, you have to kind of balance the tendency to get the too much momentum kind of process will push you to stocks that are expensive. Too much emphasis on value or mean reversion means that you can get caught in kind of the value trap where stocks are cheap, but they just stay cheap because something's wrong with them and they're not improving, they're getting worse. And therefore you don't ever really you don't ever see the mean reversion. And so, like say, the ideal scenario is if it's relatively cheap, but things are improving, there's a catalyst, something to drive the multiple to go up. That's when you get the best results typically. And so, it's hard to find that all the time, but when you do, that usually tends to be the best setup.
Mhm. And I wanted to ask you about the accuracy of analysts' earnings estimates and these forward guidance, because my hunch would be that they tend to be overly optimistic. Is there any data to confirm or dispute that?
Well, you're right. There is tendency on average for analysts for their, longer term forecasts, looking at a year or two, to be somewhat optimistic. Their estimates are higher than what actually transpires. Now, it's kind of the opposite for the current quarter, where they actually tend to lowball the estimates a little bit, so that because they want the company to beat them. So it kind of it's sort of a shift when they have a long-term estimate, they tend to be optimistic, but as you get closer to the current time and reality, they actually tend to kind of shift to lowering the bar far enough for the company to hop over it. So there is a kind of a pattern to that on average. But I guess what's important to me is not the level of their forecast, meaning if they're too optimistic, well, on average, that's actually doesn't matter. What matters is the direction change. And so that's why the revisions to the estimate are really the driver. If they were expecting one number and now they expect slightly more, that's the important part. And if they're cutting their estimates from whatever level it was, that directional movement and the magnitude of it is what's important. So in some ways, I don't really care if they're too optimistic or not. It's whether if there's news comes out and they raise their estimates for whatever reason, that's incrementally positive news. And that's going to probably drive the stock price higher rather than lower. And that's what I'm looking for. And the fact that they tend to be kind of predictable or persistent, once they start raising their estimates in one direction, they actually tend to keep going for months at a time in some cases. And so once I see that there's a lot of estimates going up in the stock or this industry, then I know there's a good chance they'll probably keep doing that for a few more months. And when they do, stock prices will respond to that because that's what they've historically done. And, investors respond to estimates. And so that's the kind of how you use estimate changes and analyst behavior, in your favor, to take advantage of that, to make it somewhat predictable for stock returns. And so we find that the stocks that have the biggest upward revisions tend to outperform those with the most negative revisions without really concerning yourself too much with the level of the estimates, because those kind of wash out over time. It's the direction that matters for the next 3 to 6 months.
Right. And I guess how long does it typically take stock prices to incorporate that information? And I guess how quickly would you see that positive gain in the stock price following an analyst revision, a positive revision?
Right, right. So it can take, sometimes, weeks or months for the kind of the news to really filter through. And because these analysts tend to kind of move incrementally and as a herd, one analyst will raise numbers and then later another one might, and they might kind of follow on each other for a while. And each time that happens, you'll get some impact on the stock price. So you'll get this kind of, persistent impact kind of, over time as the news kind of filters through and the analysts respond to it. Maybe the company update this guidance. And there's also tends to be kind of there's momentum in the actual businesses of the companies. If a company comes out with a new product or service and it turns out well, it's not going to just be something that happens in one quarter and then goes away. They'll probably have, good trends in their sales and their earnings for a little while. And so it may take a little while for analysts or even the company itself to catch up to that and to sort of, fully incorporate the news that that their new product or service or whatever it is has caused. And the same is true on the downside. If things start to go wrong, they tend to kind of maybe keep going wrong for a while longer. And so it takes time for those things to play out, both in the market and for analysts. And so you can see 3, 6, sometimes, months or a year before that trend really plays itself out. And so I think that's one thing people maybe misunderstand. They assume, well, some news comes out today, the stock goes up, analysts have raised their numbers, it's all over. Everything's, already accounted for. And actually, in reality, there's a good chance it will continue for a little while longer. That kind of post earnings announcement drift or the trend will actually persist for weeks and months sometimes, but it will get, that'll get overlooked once the day is over. So that's what you're kind of taking advantage of and using this kind of strategy.
And then are you focusing on the revisions to earnings per share, or do you also focus on the revenue growth and I guess margins if I guess even earnings per share doesn't perform as good as the other two?
Right. So most of the work that I do is focused on earnings per share estimates, kind of the more bottom line number. Um, there are certainly estimates for sales or dividends or book value or other measures from the income statement or the balance sheet. Now, there's one thing is that analysts, when you look at what analysts actually forecast, what they publish and submit, to their earnings estimate services, the most commonly estimated item is earnings per share. So that's where the most, kind of estimates are, and they are the highest quality or kind of depth of earnings estimates. The other thing is that when they raise their forecast for earnings, they're almost always going to be also raising their forecast for revenues and for margins, or even if margins stay the same. So if you're looking at the direction they're moving, it's very rare to see them raise their earnings but lower their sales numbers or vice versa. If you know which way earnings are going, you pretty much kind of know which direction the other items are going. Know whether it's exactly the same amount percentage wise. Yeah, that'll vary. But if I want to know just directionally which way things are moving, the earnings estimates will generally get you to the right direction. And then you can go and then look more closely at what's going on within the margins or the other measures to see if there's a more complete story to tell there. And so we can do that for clients as well. Look more in depth. And certainly clients, that a lot of my clients are professional money managers. They're institutional investors and they're doing their own research, and they might be doing that themselves. But I can help them narrow down the list of say, okay, here are the stocks where the estimates are rising and things look fundamentally good and have good support from the price and the valuation. So, maybe go and do your research here and don't bother with the ones that look weaker right now. And so I'm not going to be at the end of the story, give them a good pond to fish in some ways, or a directional indication of which way things are looking for a company. Basically, if you get the EPS numbers moving the right direction, the other things tend to follow along.
I really like this strategy. It helps narrow down. It's a screening process essentially from top down on to help you find great companies. And so I guess I'm wondering on a sector level, now that we know your checklist, what you look for, what are some sectors that have the best prospects for you after we just saw some revisions come out from analysts recently?
Yeah. So right now, when I look through it, I see that, like I mentioned, technology is actually surprisingly strong. But you kind of have to take out the mega caps, the Apples and Microsofts and things that have a huge amount of weight in the technology related indices. Um, but that the average kind of technology stock is actually doing relatively well on earnings estimate revisions basis. We're also seeing relative strength in like the industrial sector, certainly transportation related stocks, airlines and things like that are holding up fairly well. You're starting to see some of the consumer discretionary stocks hold up relatively well, whether it be retail or some of the other areas. And there's been certain parts of the financial sector that have been holding up better when the stock markets and things do better than things like capital markets and insurance have been relatively good. Now, the banking sector, banking industry has been weakening actually in my work for a couple months now and is having some troubles lately. But other parts of the financial sector have been doing well. And so when I look overall, I'm seeing generally, those kind of more cyclical parts of the economy, doing fairly well. At the bottom of the list, you still see kind of real estate, which is, under pressure, both from kind of post-COVID, people not going to the office anymore, or higher interest rates because they're very interest sensitive. Some utilities, some healthcare, some consumer staples. Those are kind of the areas that look relatively weakest on earnings revisions and the overall kind of scores and rankings that I look at. So, if I'm looking at it overall, I'm saying the more cyclical areas, the areas that are benefiting from a strong job market and that are either less interest sensitive or that are benefiting from lower energy costs. So oil prices have been coming down, gasoline prices coming down, natural gas prices have come way down. So all the industries that use that's a fuel cost or an input cost, they're actually benefiting. And same thing with consumers not having to pay as much to fill up their tank. All those things help the earnings for energy, users, but are hurting their earnings forecast for oil producers. So they've been starting to weaken the last few months. So that kind of rotation from energy producers to energy users, and companies that are very interest sensitive have been under pressure. Ones that are less have been doing better, and that the job market growth, the retail spending's holding up. That's all coming through in the earnings for stocks and industries that are sensitive to that.
And then from there, once you've kind of identified all those sectors, you go in and look at the list of companies, and that's where the valuations come in. And you kind of can filter through those and do that. That is the second, I guess, step in this process.
Right, exactly. If you take kind of a top-down starting point, you look at the kind of big broad sectors, kind of which parts of the economy and the market you want to be in. Then you can drill down into specific industries. Do I want to be in software or semiconductors or insurance or banks? And then you can drill down in individual companies. Because within any sector industry, there's always a wide range of companies, some doing better and some doing worse. And so you can then filter in and say, okay, here are the specific names that have strong revisions and their price momentum is relatively strong and their valuations are relatively favorable. And therefore, they're more likely to outperform even within that specific industry versus stocks that are weaker within that industry. And so again, depending on how the investor or the client that's looking at this is set up, they might focus very much on the individual names within one specific or a few specific industries, or they might look at the whole broad universe of U.S. stocks and say, I don't really care what sector it's in, just give me the strongest individual companies that have strong products and services and have the most aggressively rising estimates and focus on those. So you can kind of slice and dice it however you like, and do it by sector or even by size. You can look at small caps and large caps, or by style, growth stocks and value stocks. So I can kind of carve up the whole list of stocks however someone might want, but the general principle is the same. You want the strongest stocks, ideally in the strongest industries, give you the most kind of tailwinds behind you, to kind of use the sailing analogy, to be able to find the strongest names, things that are most likely to outperform.
Right. So you mentioned this is kind of a momentum trade in a sense, or one part of it is based on momentum. So I'm wondering, how long are you typically holding these securities for? And I guess what would the catalyst be to cause you to sell it then? Would it be downward momentum?
Right. That's very much the principle behind a lot of this is the kind of momentum and looking for alignment between what I call fundamental momentum, the earnings estimates, price momentum, and then valuation is kind of the counter to that. And so most momentum oriented kind of equity strategies tend to be oriented in kind of anywhere from 1 to 6 months. In some cases, the trends in these stocks will go on for longer than that. You can see strong momentum for a year or two. There's certainly plenty of examples of that, of growth stocks that just kind of keep outperforming, keep surprising. Um, it's not the majority, but there are certainly those names that show up like that. But I would say kind of 3 to 6 months is typical. Sometimes 9 months or a year. Now, to be clear, Mill Street Research does not manage money, so I'm not actually trading any of these stocks. But the investors that use it, and the way the models and the rankings tend to sort of turn over is that kind of intermediate term, 3 to 6 to maybe 9 month kind of horizon that these trends play out on.
hmm And the last question I want to ask you for today is your longer term outlook for the market, because I heard you talk about previously how in a longer term model, when looking at, I guess, this extended time horizon, the expectation is that real earnings growth is expected to be about zero over the next 10 to 20 years, whereas in the past it was more around 4%. So is this something that you're still expecting, or could you paint some color on this? Because if earnings growth is expected to be zero, what does that potentially mean for longer term stock price appreciation?
Oh, that's right. That's right. So I do have another indicator that I look at that basically tries to answer the question, what is the market pricing in right now in terms of long run real, meaning after inflation, growth expectations for earnings? So it's answering the question, what is the market thinking? What is it pricing in? And then, of course, you have to compare that to, what I think or what you think about what's really likely to happen. And so in some ways, it's a measure of what investors are doing or saying right now. And then looking for situations where everyone is very pessimistic and expecting very low growth, then, any kind of good news or upside would be favorable for stocks. The stocks, participate in long run growth and bonds don't. Whereas if everyone is already expecting very high growth, they're already very optimistic and think things are going to be great, it wouldn't take much disappointment for stocks to kind of underperform and get knocked down. And so right now, or for several months now, the model that I use for that has been showing that based on current earnings and inflation and stock prices and bond yields, that it wouldn't take any about zero real growth or just like marginally positive real growth to make you kind of indifferent between stocks and bonds. That zero real growth would kind of make the outlook for stocks and their outlook for corporate bonds roughly equal, kind of on a 10 to 20 year basis. And that seems pretty low to me, meaning that if the real earnings growth in the U.S. has tended to average anywhere from 2 to 4% over long periods after inflation, that zero would be much worse than average. So you'd have to assume that there'd be very little economic growth and that U.S. corporations would have no way of really growing earnings for a long time to make that a reasonable or a good assumption. So to me, what it tells me is that expectations are very low, and that therefore you wouldn't have to be convinced of particularly much growth coming along the line for stocks to be attractive. As long as stocks will be better than what the market is pricing in, or if earnings growth is higher than expected, stocks tend to do better. They tend to rise, or at least do better than bonds, to say that. And so to me, this is sort of a sentiment indicator in some ways, saying that sentiment is still pretty pessimistic based on current, way things look right now. And therefore, there is potentially more upside than downside to expectations, as long as earnings growth is at least somewhat positive over the next 10 to 20 years, which I think it will be. I think earnings will still continue to grow, maybe not as fast as they have, but still positive. And therefore, stocks have a better chance of beating that hurdle than missing it.
Okay, that was very helpful. That was such an insightful conversation. Thank you so much for taking the time to come on today and share all that knowledge with us. Before I let you go, though, where can our listeners go to learn more about you and then everything that you do at Mill Street?
Oh, sure. Well, no, thank you for having me on. And certainly, if you want to find out more, millstreetresearch.com has a lot of information about the work. It has sample reports and a lot of things on there. There's a blog where I update every once in a while that gives some background and information about what I do. There's also a report that I put out every week now that maybe even individual investors might like. It basically gets sort of a slice of what I do for the institutional investors that I deal with. and then it's called the Weekly Roundup, and it's $50 a month, and so it gives you a way to track what I'm doing without having to kind of pay the rates institutions do. That's on the website as well. And then I've been posting on Twitter and LinkedIn reasonably often, kind of just comment on what we're seeing, what I'm seeing in the markets in response to economic data and things like that, and giving again just sort of snippets and slices of indicators that I look at. So at Mill Street Research on Twitter, same thing on LinkedIn. You can kind of keep an eye on that and see what kind of what things I'm talking about. And then anyone can reach out. info@millstreetresearch.com is the email address if you want to write in and ask questions or see about the research.
Perfect. I will make sure to put all of those in the show notes. Thank you so much for coming on today, Sam.
My pleasure. Thank you so much for having me.
Whenever the Fed raises rates this much, they're going to break something. Usually your odds are not in your favor there, and you're better off just staying away entirely and focusing on the businesses that are getting stronger over time. Historically, when we've looked at that, it's usually just a matter of time before they start to disappoint in the marketplace.